If you're watching this video, you've probably heard about Ethena. In the last few months, it's really taken over the crypto world, and a lot of people are championing it as one of the big innovations of this cycle. Its TVL has skyrocketed to over $2 billion. It had a massive airdrop, and its fully diluted valuation is now more than layer 2 networks like Starknet, Optimism, and Arbitrum, and also more than other big protocols like Filecoin or Celestia. But everything is not as it seems with Ethena. Even though the founder, Guy, has been on pretty much every single podcast talking about how it's not as risky as people think, most of his points could have been rebutted with simple questions. The reality is that in its current form, Ethena is doomed to fail as a protocol. And there's a good chance that a lot of its users will be burned in the process. So in this video, I'm going to take you through quickly what is Ethena, why it's doomed to fail, the possible scenario in which this will happen, and how it will affect the broader crypto markets. Just as a reminder, for me to give you financial advice, I would need to be aware of your specific financial situation. For that reason, nothing in this video is financial advice and it's for informational purposes only. So Ethena really had their big launch in February of 2024. Immediately, they started advertising insane APYs on their stable SUSDE token. And they'll be one of the first ones to tell you that they were the fastest stablecoin protocol to reach 2 billion in supply. At the time of recording this video, the Ethena TVL is hovering around $2.4 billion. And the founders are obviously feeling themselves, posting things like Ethena fudders are more retarded than Luna supporters. As many of you subscribers know, I've called out protocols many times before on this channel, including Luna, and time has proven me right every single time. Whenever the crypto world gets excited about a new crypto protocol, advertising insane APYs with a founder with a lot of hubris, my interest gets piqued immediately. And the more I researched Ethena, the more I realized that users and the founders are severely underestimating their risks. So when it comes to Ethena as a protocol, there are three big risks: funding rate risk, counterparty risk, and liquidity risk. So let's start with funding rates and a tiny bit of background on how Ethena actually works. Guy Young, the founder of Ethena, is on the record saying that he's not worried about funding rates and says that it's talked about way too much in comparison to the other risks that I just said. But the entire protocol is based on funding rates. In crypto, a lot of speculative trading happens on perpetuals exchanges. These exchanges let you trade leveraged long or leveraged short different crypto assets without actually owning or trading hands with the underlying asset. But there's an inefficiency in these exchanges. Mainly, if there's a lot of one-sided interest in a specific asset, they can get unbalanced. If everyone thinks that ETH is going to go up and has leveraged long positions on ETH, then who is going to pay the winnings if ETH actually does go up? So funding rates help keep the balance. Whichever side of the trade has more interest, people betting on that side have to pay a funding rate to the people on the other side of that trade. Because most people who are trading crypto are bullish on crypto, there's a long bias on these assets. So how is Ethena actually taking advantage of this? They're doing that with the basis trade. Ethena's basis trade is that on one hand, they buy ETH spot, which is actually buying the Ethereum tokens. And on the other hand, they short the same amount of ETH on a perps exchange. These trades cancel out. If Ethereum goes up, they make money on one hand and lose it on the other. And if Ethereum goes down, the opposite happens. They just stay even. The special sauce is that because they're short ETH on the perps exchange, if funding rates are positive, then they'll be getting paid by those who are long ETH on the perps exchange. This interest rate is the money that Ethena makes. Pretty much all of their earnings is coming from the pockets of those who are betting long on the perpetual exchanges. So in this chart, you can see the historical funding rate for Ethereum over the last few months. It's true that since inception, funding rates have pretty much consistently been long for Ethereum. And anytime anyone asks a question about funding rates, Guy points them to the historical data. But my question is, what are the fundamental first principle reasons why funding rates will stay long? You see, there are lots of situations when historical data doesn't work. Here's a chart about the life of a Thanksgiving turkey. And as you can see, their life is pretty good. They're eating well, frolicking around the farm, getting fatter and fatter and fatter. Looking at the historical data, you'd think that their life would only continue to get better. But obviously, it just takes one moment in time for everything to change. There are literally hundreds of charts like this in the finance world. Here's a chart of the performance of long-term capital management, which was a hedge fund made up of economics PhDs. They were basing their trading strategies on historical data, which worked until it didn't, and the government ended up having to bail them out in order to prevent a collapse of the financial markets. Now, if you don't believe me that Ethereum funding rates can go negative for a sustained period of time, look at Solana funding rates. For 2 entire months between August and October of last year, these rates were predominantly negative. If this happened to Ethereum, Ethena and its users would go from making millions of dollars every week to losing millions of dollars. If you were in a protocol where your dollars were earning negative interest and you were losing money, why would any rational actor stay in that protocol? If this happened, it only makes sense for all of the TVL to drain from Ethena. So beyond the idea of historical positive funding rates, Ethena has 3 main counter arguments to this funding rate problem: staked ETH yields, their insurance fund, and a self-correction of funding rates. So remember when I said Ethena was holding Ethereum on one hand? Well, because you can stake Ethereum and earn interest on that asset, it can offset some of the problems of low funding rates. But there are 2 main issues here. The first is that Ethena is holding only 14% of their assets in liquid staking tokens. The vast majority of their assets are not earning this interest, which puts the protocol revenue from this staking at around 0.4%, which is really quite insignificant given the volatility of the funding rate swings. So their second argument is that they've been stocking up an insurance fund in order to protect against this situation. But this has a few major issues. Currently, the insurance fund is very small compared to the overall TVL of Ethena. They're going to need time in order to build up the reserves of that insurance fund before an emergency happens. But their insurance fund is entirely dependent on unstaked USDE. The problem is there's literally zero reason for any holder to hold USDE that isn't staked. Holding USDE that's not staked is holding a stablecoin that's earning 0% interest with a much higher risk than stablecoins like USDC, Tether, or DAI. But if you look today, the vast majority of Ethena's TVL is in unstaked USDE. The only reasons users are doing this is because they're earning points hoping to get the next Ethena airdrop. But there are issues with this. The first issue is that airdrops don't last forever and there are only so many tokens that you can distribute to users, which means you'll see rapidly diminishing returns for holding USDE. The second thing is that this actually introduces a negative feedback loop to the system. If something happens and the price of the Ethena token starts dropping because people start leaving the system, the value of any potential airdrop also starts to drop, which might cause users to shift their USDE tokens earning points to other places in DeFi, which would cause the TVL of Ethena to drop even more and cause more users to pile out. And because of tools like Pendle that let us see the expected APY coming from token airdrops, it will be extremely obvious to users when the market no longer values this airdrop as much as before. And finally, there's zero documentation or guidance on when the insurance fund will actually be deployed. So you're really just praying for the Ethena team to get it right when the time comes. So the last argument from Ethena is that funding rates will self-correct. Because Ethena makes up a big portion of this trade, as funding rates get lower, people will leave their protocol, which will put less pressure on the down funding rates and make the funding rates go back up. This actually will be a helping factor in keeping funding rates positive, but the real question is if it will help enough. If there's still a negative bias on the future price of Ethereum, funding rates will still be negative no matter how many people leave the trade. And if funding rates drop quickly enough, there could still be a liquidity crunch. So let's talk about liquidity. Currently, there are 2.3 billion USDE tokens, of which 300 million of those are staked. These staked tokens have a artificially enforced cooldown period by Ethena, which means you have to wait between 7 and 90 days to unstake your tokens. The current cooldown period is 7 days, but if you look at the actual smart contracts, Ethena has the ability to bump this up to 90 days whenever they want. And they've had absolutely zero communication on why this is baked into the protocol and what situations would cause them to increase the cooldown rate. During that entire time, users, not Ethena, will have to eat the losses of negative funding rates. So what if you actually don't want to eat those negative funding rates, or in what would likely be a very negative market situation, you just needed access to that capital? The only option is secondary markets. So as of right now, the only real staked USDE secondary market is on Curve. This is not nearly enough to support an exodus of users who want to unstake their tokens, because if funding rates turn negative, everybody will want to unstake their tokens. It's not something that a couple people are going to do at a time. It's something that everyone will do at the same time, and obviously there's not enough liquidity in these secondary markets to handle that. This would cause the price of SUSDE to drop. Price fluctuations are one thing, but Ethena has been pushing and pushing and pushing more and more DeFi protocols to accept SUSDE as collateral. In fact, this is one of their primary goals, to make SUSDE a collateral asset. But if SUSDE is used as collateral in a lot of these systems, this could start a liquidation cascade, which would further push down the price of SUSDE. The more SUSDE being used as collateral, the bigger risk there is of a sudden shock to the system. Jumping over to the unstaked part of the token, USDE, their redemptions currently are only done by Ethena. Ethena says that they are working with market makers to mint and redeem their token, but minting and redeeming is only available to those on a whitelist. And if you look on chain, every single address minting and redeeming is getting gas from the same source. So they're all connected. Again, Ethena has communicated nothing about this to their users, and my suspicion is that they are currently the only ones that have access to this mint and redeem feature, which means all of this capital is relying on Ethena to execute properly in this situation. And no one really knows how quickly they would be able to unwind $2 billion in choppy market conditions if they needed to. But I've talked to some experts in this area, and the consensus is that it would be really, really hard. So the final big category of risk for Ethena is counterparty risk. They are currently holding positions with Binance, Bybit, OKX, Deribit, and BitGet. In crazy market conditions in the past, we've seen exchanges freeze assets of users. Ethena's assets are exposed to counterparty risk of all of these exchanges. If any one of these exchanges fucked up, it would come back to Ethena. But more than coming back to Ethena, it would come back to their users. So I know that was a lot of different information, but let's put it all together into a single scenario that is actually possible. How could this big house of cards finally come tumbling down? The first thing is some bearish event to Ethereum and Bitcoin. There are a million types of bearish events that could manifest. Major regulation in the US or in Europe could pass. There could be a blow up of some other DeFi protocol. It could even be as much as Solana overtaking Ethereum as the primary blockchain. If you've been in crypto long enough, you've seen events like this happen pretty much every cycle, so it's really not that far-fetched that something crazy would happen. So let's just say some bad event happens, the market turns bearish, and funding rates start to go negative. Remember, funding rates don't actually have to go negative for money to start flowing out of Ethena. You see, Ethena is in competition with a bunch of other protocols. SDAI, for example, is currently yielding 15%. Any logical actors would move their investments from SUSDE to SDAI the second that funding rates dropped below 15%. The only reason people aren't doing that right now is because of the hopes of an airdrop and because of the artificial friction that Ethena introduces with their cooldown periods. But if we were in a bear situation and funding rates went negative enough, you would start to see money flowing rapidly out of Ethena protocol. So as users start to flow out to avoid eating those negative funding rates, they'll run into a wall with the limited liquidity in the secondary markets, and the price of staked USDE would start to tick down. Because this token is being used as collateral in the system to go leverage long, you have the market melting down at the same price as their collateral is ticking down. And this is going to lead to liquidation cascades. I feel like people don't really appreciate that almost every risk in this system is correlated. If you have people flowing out of Ethena, you likely have problems in other areas of the crypto markets as well, which means all of these exchanges will be under strain. So the counterparty risk goes way up, which means that you're not going to get these risks one at a time. You're going to get all of them at the same time. As the liquidation cascade continues, pretty much everyone will try and unstake their USDE in order to avoid the carnage. While all of this is going on, Ethena will be doing their best to redeem these tokens for their underlying collateral and unwind all of these positions across all of these different exchanges as fast as they possibly can. But any minor hiccup in that process would cause a lot more fear and uncertainty in the markets, causing a lot more outflows and making the problem worse. The kicker in all of this is that while users are getting screwed, getting their positions liquidated, and being unable to pull their money out of Ethena, Ethena remains protected. Ethena has built this system in a beautiful way where all of their risks are passed directly on to their users. Even if the price of SUSDE is trading at 50 cents on the dollar in secondary markets after liquidating a ton of people, they can just crank the cooldown period up to 90 days, sit on their collateral, and wait for market conditions to change. Because right now, they're likely the only ones that have access to this mint and redeem feature, unstaked USDE could also be trading at 50 cents on the dollar, and they wouldn't even care. If any of these partner exchanges got into trouble and froze withdrawals of Ethena's assets, they could just sit on their hands, let the situation play out in the courts, while their on-chain tokens are trading at fractions of the original value. You see, even if Ethena knows that they're screwed in a situation like this, they also know that the vast majority of the harm goes on to their users and not on to themselves. You can see the disrespect that they have for their users from the very beginning of their launch, when they were advertising the APYs to represent the entire protocol revenue. But when it came time to actually pay out their users who were staking SUSDE, they gave them a fraction of that. Also remember that they were so happy to tweet and aggressively market every single weekly payment that they sent to their staked USDE holders. But the second those funding rates started going down, not only did they stop tweeting about it, but they locked comments on any of their tweets so that users couldn't talk about it. And keep in mind, if any of these things happen, the price of Ethena's ENA token would also dramatically crash, which would just make the whole situation worse. Given all these systemic risks that we've outlined on one side, combined with the fact that this is a protocol that has been aggressively marketed, aggressively integrated, and has not communicated with their users, I've recommended to all of my friends and family to not touch this thing with a 10-foot pole. I'm not saying Ethena isn't a useful protocol. It is actually an interesting way to tokenize the basis trade, but it's a niche protocol that is definitely not revolutionary and will likely see its TVL go to zero at some point in the future, even if it doesn't crash. The good news is, you don't need to touch Ethena to take advantage of these high funding rate APYs. The founder of Ethena said this trade is so easy that a grandma could do it, when you could move in and out of this trade as quickly and whenever you want by doing it yourself while still earning the same returns. If you actually are interested in doing the trade yourself, drop a comment and I will do a tutorial video on that. Thanks for watching.